So I was doing CNBC yesterday, the halftime show, and I don't know if you've ever paid attention to like the order of which the host Scott goes to each person on the show to ask their input on a thing, but
no, but it sounds political.
Well, no, it's not. It's literally physically in the order of where you're sitting. So I happen to be sitting in the fourth seat yesterday. So I listened to the first three people give their rationale for why the market was behaving the way it was behaving at the time. And then as I'm sitting there and I'm listening to everybody so exuberant and so positive about this market and how like it sounded as if nothing could go wrong. I was just sitting there and I'm thinking like, am I the only sane person in this world of crazy that sees how many cracks have formed in this facade and we keep on marching to the beat of the same drums that like can't go on forever? Yeah. And literally, so as I'm sitting there and like Scott turns to me and he's like, what about you? That's like literally the first thing I blurt out is like, am I the only sane person here? Like, what am I missing? And it's like, it made me think like, have you ever had one of those moments where something in front of you happens that is like so crazy, but no one is reacting in the way that you feel like they should, and it makes you feel like you're the crazy one?
Yes, or you're in an argument with someone and you're like taking a side in the argument, but you're like, I don't even understand the premise of what we're arguing about right now. This feels like I'm in Crazyville.
Well, that sounds like marriage, but anyway.
Or friendship.
What is marriage if not like a deeply rooted friendship?
Are you taking shots at Sam, or are you taking shots at your own relationship?
I'm not taking shots at anyone in particular. I'm just saying that sounds, I mean, I'm the child of two married people, right? So I've seen marriage up close and see how I'm walking this back. Like I have seen marriages function from the inside. Like I'm just saying in general, as a general observation, that sounded like a marriage that you were describing.
Just sounds like you're on a widespread carpet bombing campaign. Widespread carpet bombing podcast campaign. Now you want to do the show?
I think we better just do the
Betterment survey. Let's do this Betterment survey because this is making the rounds.
Please.
I'll give you the stats. 26% of Gen Z investors now treat sports betting as a deliberate part of their long-term financial strategy, which I do think there is some question engineering in that, if that makes sense. Like if I ask you yes or no, is sports betting a deliberate part of your long-term financial strategy? You may not have thought about that previously to me asking the question in the survey. Simultaneously, though.
But I think that nuance says a lot, though. Let's say that you're right, and the question does appear verbatim that way. When you see the words long-term financial strategy or long-term wealth building strategy, shouldn't your brain trigger to say, well, no, it's not a long-term thing. I just do this for entertainment. And if not, therein lies a lot of the problem we're preparing to discuss.
Yeah, fair. Now, here's the real one that is concerning. 52%. And this is 52% Gen Z, 10% Gen X. 52% of Gen Z have redirected money originally intended toward investing to sports gambling within the past year. This isn't good. This is like a slow breakdown. I feel like I'm looking at a survey and it's like, interesting takeaway. And I'm just seeing a slow breakdown of civilization.
Yeah.
Where this doesn't get better.
You call me a pessimist all the time. And I say, welcome to the party. I consider myself a realist and I just see things for what they are. And I think this is a slow degradation of society in a bunch of different ways. However, I will do my best to stay focused on the subject in front of us and point out the fact that the reason this matters so much is because when you invest dollars, even if you're making speculative bets, let's say crypto, for example, which is, remember crypto?
I do. And in fact, I'm picking up a little Bitcoin lately, by the way.
That feels like a word from a bygone era. But anyway, so by buying crypto, if you bought Bitcoin today at, was it $60,000 or something, and it fell by 50%, it's still an asset that has a value of $30,000 per token. And so if you continue to hold it, there's a chance that it could go from $30,000 back to 60 or up to 100 or up to 200 or up to $1 million, like some people say. However, when you place a bet, it's binary. It's heads or it's tails, and you win or you lose, and then the money's gone. And so you're basically taking something that was a non-zero number percent chance that you could be successful and turning it into a absolute zero number by gambling on the flip of a coin toss.
So you're saying that it's not an asset class. The survey describes sports betting as an asset class.
Yeah, it's even worse. It's even worse than the most speculative asset class there is. And so as I'm reading this piece in Bloomberg that is like highlighting the Betterment survey, they're interviewing somebody that's saying, oh, I do my research before I place my bets, and I only allow myself to bet up to $100 per event and those kind of things. What kind of research could you possibly be doing on, I don't know, Spain versus, Jesus, I'm blanking on.
Can you think of another country in Europe right now?
No.
How fried is your brain, Malcolm? I know
I'm trying to remember the World Cup. It was
Argentina?
Argentina, thank you.
There you go. Okay, I got you. I thought you were just like searching. I thought you were like searching for another random.
No, I know geography.
You got it, Malcolm. You can do it.
No, I know geography.
Yeah. Okay.
I'm just saying, Jesus, you made me lose.
Okay.
My point was the World Cup match between Spain and Argentina. What research can you possibly do on that match before you wager $100, $1,000, $10,000 that could have, would have, should have gone toward just buying Vanguard total stock market and going on about your regularly scheduled programming? That's
boring. I agree. I think it's wrong to call sports betting an asset class.
But it's crazy to think that people do.
The books behind you are an asset class.
Sure.
Like I have a couple of comic books behind me. Those are an asset class. Those are a thing you can hold on to. They will probably lose money, but it is a physical thing that Ricky Co. could keep on their balance sheet.
I wrote one of the books behind me. I hope it doesn't go down in value. That would hurt my feelings, but I understand what you're saying.
I said behind me, not you.
Got it.
That's behind me. That's why I did the point. For those watching in video, I did like a over the shoulder thumb point to my books. I just the language disturbs me a little bit. Things are slowly. It's like I'm working on an overall economic theory that just the bar is getting lower.
Yeah.
In so many respects, where you even totally unrelated to sports betting, but even the dating app Bumble now, I talked about this on The Indicator, but the dating app Bumble, the whole thing was that women messaged first and you only had 24 hours. And now the stock goes down like 95%. Their paying users are going down. And you just see leadership taking a sigh and saying, okay, fine, men can message first. We're extending the first window from 24 hours to 72 hours because we don't want you to feel too much pressure.
That smacks of desperation. I think that's essentially what you're saying. But I also think from a business model perspective, it is kind of the last thing the last lever you have to pull. Because there's a reason why ladies get in free and guys pay at the door when you go to a club, right? Like there's a reason why ladies drink free and guys pay $50 million at the bar. Like there is a very clear line between guys are willing to pay to show up to a place where they know women will be, and women are like, probably going to be a lot of creepy guys there. I'll stay home.
I have seen some examples. I think it was one of those, this is a social media post that I believe came from The Economist. I'm trying to source it correctly. For a lot of these single events, they're actually letting men in free now because the men want to stay on the apps. They don't want to show up to the singles mixer event. There's more women willing to go to that.
Wow.
The bar is getting low. I can't emphasize enough how low the bar is getting.
That is like the slow speed degradation of society I'm talking about in a whole different form.
Because if you're a boy that goes there, the women are usually maybe bring a friend. For a guy, that's harder. Like it's it's emotionally vulnerable to show up to a singles event and try to meet someone. Can I give you one little piece of optimism with the gambling?
Please. I'm actually begging you for optimism this time. That,
at least in the state of Colorado, we're seeing at least a minor amount of restriction on sports betting, where they're limiting the number of deposits, which, cool. They banned bettors from using credit cards to fund a sports betting account.
Okay, I applaud that part.
Because the DraftKings is not going to restrict that on their own. Or free market sports betting will allow you to use a credit card. And I think this is a significant one, is that they are banning sports betting apps from sending push notifications or text messages to Colorado account holders that solicit deposits or bets.
Okay. The last two, you got me. I can't pay my mortgage with a credit card. So why should I be allowed to wager, buy a sports, place a sports bet with a credit card? So there you go.
You feeling better?
I am.
Feeling better for the rest of the show?
I actually don't think you can buy lottery tickets with a credit card.
I'm not certain.
I'm pretty confident you can't. Okay. At least here. So there's that too. Like, I'm pretty confident. I'm seeing on all the machines like that they have in the grocery stores and stuff. It says no credit cards.
All right. Rest of the show. Because I have nothing other than I'm not certain. That may be true in some states, not true in others. Our email is thistimepod@gmail.com. You can also find us in the Spotify comments. Let's see what I promise for the rest of the show. I want to talk about Reddit. It just got included in the S&P 500. Want to bounce some ideas off Malcolm, see how it goes. Malcolm, a little bit early, but he has joined Bill Ackman as a activist investor in Netflix. So congratulations on your partnership, sir. You were talking about Netflix earlier on the show a few weeks ago, and it looks like Bill has stepped up as well. And then I would really like to get into this margin story. Some reporting I did for The Indicator about the record levels of margin debt in the stock market. And there may be some takeaways for those interested in investing in stocks. So let's get into it.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
Even at the beginning of the show, Malcolm, you were a little bearish on the stock market as a whole. However, you have been positive on Netflix.
Sure.
So that's good. And now your friend Bill Ackman is joining the club.
My friend Bill Ackman, that's funny.
Friend of the show.
Maybe he listens to the show. Maybe he gets his investing ideas from us. Who knows? We don't know, so I'll just take credit for it. It's kind of like Schrodinger's cat. I think like the reason I am positive on Netflix while also being somewhat bearish on the overall market itself is that I think the stock has like been de-risked about as much as it can. Like, it's basically a stock that typically trades at a significant premium to the market that's now trading in line with the S&P 500 in terms of its valuation, its forward earnings multiple. And so I think that's probably some of what someone like Ackman is looking at and saying, where can I find a beaten up sort of stalwart company? This is a very quality company with a solid management team. These people are all lifers who work at this company. And so it's a company that is temporarily experiencing weakness, but more than likely the trend line is going to continue upward and to the right. That is the place that I personally love to buy companies.
Yep.
And Ackman has done this in the past. In 2022, he bought into Netflix. I think he gave it like 90 days or something. Didn't like what he heard about subscriber growth ticking downward for the first time in the company's history.
I remember that.
Sold all of his shares in a big huff. I think he took like a $400 million loss that they booked publicly. And then he moved on and said that was a big mistake. For him to come back into the stock now, I don't know actually what it says. I don't know if it means I should be getting out because he probably is going to be out in 2 seconds. And, the market will take that as a signal it's time to go. But maybe it's possible that he's also seeing the fact that this is a company with more than 300 million subscribers at this point. Subscriber growth has slowed, is slowing. But it doesn't really matter when you've got 300 million people that you can sell a product to that they've proven to you that they love, because you continue to flex your pricing power by increasing the monthly subscription price, and people aren't leaving. Like their net subscriber number isn't going down. They're just slowing the number of people they're adding to the platform. And so I think they'll continue to figure out ways to monetize it, whether it's through advertising, whether it's through live events, other things they can be doing. They have a $2 billion breakup fee that they need to put to work that they got for having to exit the Warner Brothers Discovery debacle. That'll be additive too. So there's a lot to love about this one, but I don't know necessarily how I feel about Ackman deciding to jump into the fray at this point, just because his track record on this particular company is not necessarily the best.
It's like, is it actually a good thing that Ackman is getting into a stock? Because this is not like hearing Warren Buffett just purchased a stock that you're already in. Like, it's maybe a little bit, he's going to be positive about it. He is a little bit hotter and colder. Like, his track record is known to be a little bit more imperfect than I find undervalued companies buy and hold long term.
He won't be a passenger on this ride for sure. Like, I think the important thing about this is he is notoriously an activist investor. And what that means when an activist investor gets involved in a company is they buy enough shares to actually warrant a seat on the board. He's got just below 5% ownership in his own personal or his own fund that he manages, but not yet 5% of the overall outstanding shares. I think if and when he gets to that number, he will become a much louder voice in terms of where he wants to see the management team going with the company. That could have an impact on the company overall. So it's just one to keep an eye on. But yeah, generally my feeling when an activist gets involved in a company is that it should be positive in the short term for shareholders, except if and when that relationship becomes super contentious between them and the board. And the board, especially if, you got the CEO of the company is also the chairman of the board, it gets contentious and nothing gets accomplished. And then the share price just kind of stagnates from there.
And I think there is a different level of ego in a media company.
Mm-hmm.
Like, I'm going to go take over a media company, say this working in media. I'm going to go take over a media company versus Southwest Airlines.
Yeah. Yeah.
Like, I have issues that I want this airline to fix, or an oil company that I think they could improve their operations by drilling more in the ocean, versus like, I got some content ideas for you over at Netflix. Like, I watch a lot of TV. I kind of know what the people are into, and I've got some ideas that I'd like to get my hands into.
Or like, I believe it was Netflix that just built this gigantic campus in New Jersey somewhere to be able to produce films and whatever. What if I, as a New Yorker, decide I don't like that? I don't like that is in New Jersey. I want you to shut it down and move it, cancel the project. Like, just something simple and silly like that could stagnate any other development that they could be focused on. Those are the kinds of petty things that you have to worry about when an activist investor gets involved.
However, I would like to see maybe a little bit more of a commitment to theatrical, which they did tease when they wanted to take over Warner Brothers, or at least get a breakup fee. Put some decent original movies, lower budget, back onto the platform, and figuring out the live event stuff. It's not just Broadway. There should be, how do you figure out Netflix lands in parks and that type of thing? That's the moneymaker for Disney. So,
you know what? Complete diversion, but I wonder if the answer is Broadway, in the sense that there's a lot of people around the country that will never go, or around the world, I should say, that will never go to New York City to experience a live version of a thing, but they might actually appreciate being able to watch it at home on their couch, wherever. And that might be something that people are willing to pay to be on the platform for if you give them 1 or 2 Hamiltons a year.
Well, the issue with that is there are not 1 or 2. There's one Hamilton. There's not 1 or 2. And I thought you were going in a different direction of like live, like put shows on Broadway, which are extraordinarily expensive. The mega hits. I think that's a good idea. I think that that often works in theaters too. Hadestown just had made a tens of millions of dollars showing a pro shot of Hadestown. So yeah, not a bad content idea. Mr. Ackman, you know where to find us. I said our email at the beginning, thistimepod@gmail.com.
If we hear that one come flying out of his mouth a month from now, we know where he got it from.
Take credit. When you run into him at the stock exchange. Let me talk about Reddit. Let me talk about Reddit a little bit, because I messaged you about Reddit before it's the announced inclusion into the S&P 500, which gave the stock a bump. And if I'll describe one of my favorite memes that I've seen on Wall Street Bets, it said, "Boys, we made it." And it's a group of fast food workers at the pearly gates in heaven. And on the sign, it says S&P 500. And that is kind of like, I get it. Gotcha. Good meme. However, this is a company that got really beaten up after earnings because the CEO, Steve Huffman, said that search traffic coming in from Google was a little bit choppy because many of the AI overviews, there was less direct traffic going into Google. However, this is a 91% gross margin company. It's the 7th most visited site on Earth. Renee Selman had a good article on Substack about this. And I think this is pretty key here. If you think about it, let's say AI picks and shovels, which people tend to like. Reddit is the #1 most cited domain across AI models. So if you want text that comes from humans, you better pay Reddit to get it. Simultaneously, they still have they've just a little bit of time left in their remaining performance obligations with Google and OpenAI. So those contract renewals are coming up soon, almost like the NFL negotiating sports rights with the different sets of networks. And I also think from a broad level that this is a good social media platform in the age of AI and influencers, where if you go on Reddit, you generally know you're getting information from other humans. And part of that is because of the downvote feature, which doesn't exist on other, I would say, social media apps. And it discourages influencers because of the anonymity. So, I mean, I've been on the platform for half my life. I looked before we recorded. My Reddit age is 15 and I'm 30. So anyway, that's the broad strokes of why I have a speculative stab on it. 31 times cash flow, 36 times trailing earnings. Not the cheapest company out there, but it's not psycho crazy for what I would say is a market leader, everlasting company with that's extraordinarily efficient.
Essentially, you're making a bet that because the content on here is all, or it should all be, human generated, it's not AI-able in that sense. And that is what is going to keep bringing people back to the platform and allow them to keep making money going forward.
That's a key part of the thesis. It's that in the age of AI slop, and also it being the firewood that fuels a lot of these AI platforms, that Reddit has a pretty extreme advantage, I would say, as they go into negotiate with Google and OpenAI, which, do you want exclusivity for our content? And I don't even know how you properly price that, because when they go to renewal, I think it's going to be a pretty extreme number. And it also, I've heard this theory and I believe it, it may not be public. It may just show up in their remaining performance obligations.
I would wonder how much money they have to divert toward defending against AI slop. And I don't know whether that number is a large one or a small one. I would imagine you should be able to use AI to do the work of fighting against AI on the platform. But the reason I bring it up is because LinkedIn is having this problem right now. They're like having to fight very aggressively against all of the AI generated content that shows up on the platform, including the comments and the connection requests and the everything else. And it's really dragging down the platform. It's a place that I have spent a ton of time in the past. And I even find myself opening the app less and less now. And so reading about the struggles that they're having fighting against AI slop, and this is Microsoft money that they're using to fight this. So I'm wondering, for a company like Reddit, how expensive does it get and how much of the operating expense line item goes up because of it?
So a few key differences, I would say, that are significant. And by the way, I have had it in my head that I want to do a ChatGPT generated 10 paragraph essay on why LinkedIn shouldn't be fighting AI slop. Just see how that works out. Anyway, free marketing idea for anyone listening. Key differences, number one, are that LinkedIn has, I would say, there's a greater financial incentive there with AI scam job postings, which you're not seeing on Reddit as much. I think the moderation is not fragmented like it is on Reddit, where it's individual communities that have volunteers working to moderate the posts that are on there. Every single post that's on a Reddit community can be shut down by a moderator. Whereas I don't think that exists as much on LinkedIn, where there's that pure like content maximization strategy versus you're curated into your niche communities. Where there's the big one, like Reddit/pics for cool pictures. And then there's ones for just like Alamo Draft House or saltwater aquariums, like niche hobbies that you may be into. And so I would say that is probably why, and because it's text-based. So I think the fragmented volunteer moderation and the lack of financial incentive around like getting someone to sign up for a scam job MLM posting is why it's different from LinkedIn. LinkedIn is also a lot of people trying to market themselves to the professional community. And you want to do that quickly because you're tired and stressed. So you're going to use AI. And there is a greater demand among the professional community to be an AI thought leader.
You really think AI could start every third post with "I am extremely proud and humbled to announce that I have accepted a position that I had 6 months ago, but changed the title on it, and now I'm creating a new post to celebrate it"? You really think AI could come up with that?
I think it could. I think it's the future of AI is beyond anything you can imagine. So, anyway, that's my speculative stab. I don't have a whole lot else there. It's one of those things where it's like you can make it as complicated as you want,
Sure.
but Reddit is just kind of running. It has fuel for AI. They spent $1 million on CapEx. Like they've kind of figured out their product, and it's growing internationally still. People are getting on the platform, and they just turned on the monetization machine relatively late into the company's life cycle. 20 years into the company's life cycle, they started doing ads and that type of thing, integrating Shopify in for targeted advertising, which if you know all of my interests, even though you don't know my personal information, you may be able to send me some ads from time to time. I don't know. Just that's where I'm at. That's where I'm at on the company.
I'm going to take your word for it, and I will follow along with you on this journey. I've never spent any time on Reddit. I don't really understand the draw as far as the platform is concerned. So I'm learning from you on this one.
Do you have any like niche hobbies or things like, for example, if the next time you go on vacation, if you want to look up food in a city, I think Reddit is better. The individual food page for a city will be better than any other option.
I don't like to listen to other people in that.
You don't like to listen to other people about food you're
not
unfamiliar
in that regard.
with?
No. The wisdom of crowds is a myth. I think people lead you astray more
For
often.
food?
For everything. You're asking me about niche hobbies and using Reddit to. There are so many people that will say wildly stupid stuff on platforms online that make me not want to scroll enough to get to a well-researched, well-thought-out, well-explained post.
That's why you have the downvote. I actually can't believe you don't like seeing a good place to eat before you just show up.
The reason I never signed up to be an Instagram user in the early days of Instagram was because what I observed was every time I went out to eat somewhere, everybody would stop you from putting your fork in your meal that you just ordered and plan to purchase so that they could hold their phone up, aerial view, take a shot of the table and all the food on it to post to the 16 people who are going to give them a like that evening. And it just like ruined the experience to me. And it's like so much worse now. So
I think you're incorrectly ascribing past trauma to current decision.
Well, where I'm going with that is now everybody thinks of themselves as a food critic and has an opinion about food that I should go eat wherever I want to go. And I don't think 80% of the people who are sharing their opinion have any clue what good food is and tastes like and should be sharing those opinions. And so I don't want to listen to it anyway.
Okay, well, Reddit discourages influencers, so it is just people sharing their genuine opinions for the most part, in my opinion. Let me talk about margin. I would like to discuss my reporting on this.
Let's do it.
I did real reporting.
I will upvote your discussion. Yes.
It's something we've talked about on the show, which is a couple of questions that I have had, which are a couple of things. One, there is a record level of margin debt in the US stock market right now. The amount of money that people are borrowing to play with, speculate in the stock market, much of that, I believe, has been driven by the memory trade, right? You have these companies like Micron shooting up in value. And as those equities become greater in value, then people are able to take out more margin that allows them to increase their returns. We saw what happened in South Korea, which is that you have a stock market that it's sometimes more than 50%, it's sometimes less than 50%, dominated by two companies, SK Hynix and Samsung, at the center of that memory chip trade. And what happened is they started mixing margin in with levered ETFs, single stock levered ETFs that allow you to 2x the daily returns of certain companies. So now you have your combination of, I have margin to take out these levered ETFs. Stock market shoots up for a while, and then it goes down about 40%. Interesting things here. Number one is that about 3% of the entire South Korean adult population received a margin call saying, hey, we need you to put up some more money. It's a lot, right? Not just America. Things are tricky across the world. And 360,000 accounts were forcibly fully liquidated during that crisis. The majority of that, this according to Morgan Stanley research, belonged to people under the age of 35. So what's that say? A lot of people got a call, but a lot of the people who got killed were young people taking too much risk that didn't know what they were doing, right? Or were taking on more risk than they could handle. The rest of the story, though, which I think is interesting for this show. And I spoke with Yuri and Timmer, who's the director of global macro at Fidelity.
It sounds like you're getting ready to say this is a bad idea, but maybe these young people you describe have a level of situational awareness that we are not privy to, and they know something we don't know.
All right. He'll be at the Funny Bone this Thursday through Sunday. Where I was going with that is that for a lot of these semiconductor ETFs, there were no, the outflows were not noticeable during that crash. So the people who were able to hang on did, which I find surprising because usually when the lights turn on at the party, you would expect a lot of people to flee. Not so in this case. And then after the crash, more money seemed to inflow back into those levered ETFs because that's how strong the memory trade is. That's how strong the semiconductor trade is, no matter how often you want to yell about being a pessimist on CNBC.
Yeah, wait. This is my opportunity to explain why I am so pessimistic on this. I probably have already before, so I'm going to do it as quickly as I possibly can. But I think this is an important place to point this out. There is a shortage of semiconductors, period, whether it's GPU or CPU style memory that we need. And it is a substantial shortage because there is a substantial amount of compute that is being built in data centers across this country, right? However, it takes 3, 4, 5 years for these foundries, like a Samsung or a Taiwan Semiconductor, to be able to build enough factory space to actually create supply to meet the demand, meaning they can only fabricate so many chips in a year using what they already have as far as their physical footprint. In order for them to add one more facility, because these are very highly skilled facilities that are very intricate in the way that they are constructed, it takes a long time to actually build this. And so by the time we get 3, 4, 5 years down the road where they are actually able to deliver the supply to meet today's demand has gone somewhere else. Whether it's we've figured out another way to deliver the compute that we needed, or we don't need the level of compute that we thought we would when we were listening to people who were telling us that a company like a SpaceX is going to be more valuable than the entire planet Earth at some point, because that's how much demand there is out there for AI. And AI is such a generational transformation that, we need all of this to be built today. Something is going to shift in that narrative and in that belief within the next 3, 4, 5 years. And that is going to completely obliterate the orders that have been placed for these chips that people are banking on today. What am I missing?
What about the $500 billion financing that Jensen Huang is putting together?
Don't even get me started on that.
Like more people can buy his chips.
That
aren't creditworthy, by the way.
So what that reminds me of is the mortgage business in 2006, 7, and 8, where companies said, you know what? Selling the mortgage to another mortgage servicer, taking a little piece of the action and then going on about our business. That's not good enough. Instead, we should slice the mortgages up into teeny tiny little tranches, package them up together, and then we're going to sell basically an option against them called a collateralized loan obligation. Now we've got a loan against the loan that people are buying from us that they don't even actually have direct visibility into or ownership of the homes that are being used to backstop the loan. Now we're talking about collateralized chip obligations. This is getting absolutely freaking nuts. And it is, again, making me feel like the only sane person in Crazy Town.
Can we short it? What was the ChatGPT customer you liked again? You talked about on the show. Is it a speculative one?
ChatGPT like a chip customer. Oh, Cerebras?
Cerebras. Okay. People, you're still.
Have you seen the share price of Cerebras? Leading into their earnings, it shot up like 13%. And then after they announced the earnings, it fell by like 15%. And the consensus online was, they didn't perform well enough. Well, this is a company that's only been public for like 2 months. And basically they have 3 customers. One is the United Arab Emirates. One is CrowdStrike, and the other is OpenAI. And OpenAI is their biggest customer. I think it's like 90% of all of. So what are you talking about? They didn't meet your expectations. Why did you have expectations? This company is wildly speculative at the moment. It's a flyer. I have been calling it that for a long time. But if you are a believer in the chip space right now and the semiconductor industry right now, Cerebras is proposing to completely decimate all of the demand that you say you need, because their whole focus, their process is to take one gigantic wafer, put as many transistors onto it as they possibly can, and get rid of all the lag that exists in the GPU to GPU structure that happens in the servers that NVIDIA controls today. So if you believe that strongly in Cerebras that you are expecting blowout earnings, you also shouldn't be owning Micron and Broadcom and SK Hynix and all of those things as aggressively as you own them, because that would send the share price of those companies down if Cerebras has as good a day you're hoping it does. Again, I feel like the only sane person in Crazy Town.
I think you have the title of the episode there. The only Malcolm Etheridge, the only sane person in Crazy Town. I might take your name out of it because people know where the podcast comes from. I want to get back to these levered products,
please,
because that's a market structure question. One of the questions I had is basically the Fed can at least control initial margin, which interestingly, in my view, the Fed controls initial margin And then FINRA controls the maintenance margin. So all of the brokerages follow the initial margin requirement, which is 50%. You need $1 to borrow $1, but they're all above the maintenance margin requirement, which I think is like, I forget where FINRA said it exactly, but most of the maintenance margins are closer to like 25, 30%. And that's because it's profitable to get you in the door, but the brokerages want their money back when things go awry, right? And so the Fed can control new margin going into the stock market, but they haven't done so since 1974. And the reason that Urian Timmer told me, which I think is a reasonable guess, is that the stock market, the Federal Reserve does not want to be in the bubble guessing business. In the late 90s, Alan Greenspan called the stock market a bubble with the tech boom. Then the thing runs for 4 more years. So there's market and possibly political disincentives from being the person who turns the lights on at the party, right? And then when I looked at the history of margin in the stock market, at least in the 1940s, if you boost the initial margin requirement from 50 to 60%, it didn't change investor behavior that much, or at least it didn't in the 1940s, according to a Federal Reserve report I was reading. You had to move it from like 50 to 75% before you started noticing a difference. And then even in the post-war years, the Fed completely shut off margin altogether at 100% requirement. No new margins going in. The following year, from the peak, the stock market dipped about 20%. And then the Fed chair, Mariner Eccles, was basically saying, you're welcome. It would have been a lot worse if we didn't cut off margin. So there is a responsibility there. And there's a responsibility with the SEC that is regulating these 2x and now even 3x daily long or daily short ETFs that track the positive or inverse of a certain company. So anyway, that's what I looked into. It can work. They haven't done it since the 70s, and I think there's responsibility among several regulating bodies.
And you think this Fed will be the Fed to step in and make that call?
My job as a journalist is not to say what is going to happen. My job is to give you, just context for what's going on in the world.
I'm just saying, do you think there's a snowball's chance in hell that
Mr.
this
Warsh
Fed is going to be the one to say, you know what, guys, enough's enough.
Breaking out this tool that we...
It's time to, quote unquote, take away the punch bowl, as his predecessor once said.
No. I don't. And on that happy note, let's end it there. You can find me. Let's do LinkedIn. You can find me on LinkedIn, where I'm going to be posting a lot of AI slop. Malcolm is at Malcolm on Money, helping the show. Leaving a rating or review wherever you listen is super useful. Thanks. The show may or may not be on next week. Malcolm and I will be talking about that later. All right. Peace.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be, a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.